To keep with the global market space, I'm joined by Graham Bell. He's a strategist at Old Mutual Equities. He's from Cape Town. Graham, always a pleasure to speak to you. A good starting point for this conversation has to be Greece. There's confirmation that they will submit an extension with regard to their loan, but many people saying that big brother Germany wants no such from that small economy.
Hi, Guru. Yes, a fascinating confrontation this, and I think we'll see Greece submit this request for an extension. The Germans are playing hardball. But if you look at the situation for Greece, for Tsipras and Varoufakis, the two leaders from Syriza party in Greece, they have a difficult situation because they have a big mandate. Something like 81% of the population are currently supporting them in their current endeavors. But at the same time, 70% of the population doesn't want to leave the euro. And if Greece refuses to deal, then ultimately they'll default. And if they default, they will be forced to leave the euro. They'll come in with a new Greek drachma, which will be at a much, much lower exchange rate than currently. There'll be an even further depression in the Greek economy. Yes, it may be swift and sharp, and they might then have the opportunity to recover from there, but the pain will be very significant. So they have to act tough, and they do have a strong mandate behind them, and they have to try and carry that through, but at the same time, they will ultimately have to confront the reality of the fact that a lot of their debt is maturing this year and needs to be refinanced. And they have no choice but to do something about that, in my opinion. I do think that markets are a little bit complacent because you have to put some probability on the chances of Greece doing a Grexit and doing what I said just now about a drachma and so on. There is a possibility, and markets have been almost completely ignoring that possibility. So as you mentioned just now, you've seen a lot of equity markets making new highs. S&P 500, the South African market, Asian markets making multi-year highs. Even the FTSE 100 today, although it has weakened a bit from this morning, I think in intraday it made a new high for the last 7 years. So markets are kind of relaxed, and this may be a little bit too casual. I think we had a slow start to the year, and then we had a very good run across equity markets. And if I was a trader, I might be trying to fade this a little bit right now. But the underlying situation for equities remains positive. You've got global growth chugging along at a reasonable pace. You had a big fall in the oil price, which is a big boost to consumers in most countries. You've got central banks that are looking very unlikely to be hiking rates. You've got QE from Europe and Japan and so on. These are all supportive for equities at this stage.
Graham, I want us to prick your brain with regard to the economic data and how it correlates with the stance and the movements we've seen from central banks. Just yesterday, the UK's inflation rate dropped to 50-year lows, and I understand today we're expecting US PPI. Surely this gives the FOMC, which will be meeting later on this week, quite a bit to consider.
Well, the FOMC minutes come out on Thursday. The next meeting is next month. So the minutes will reflect what they were saying at the last meeting, which was actually pretty confusing. But the Fed has been wheeling out several governors in the last few days, and most of the comments have been quite hawkish. But the Fed has a dilemma because the dollar's been strong, and that is in effect a kind of monetary tightening. And the oil price has fallen sharply, and the PPI number came out this afternoon. That was sharply down from the previous month. And CPI is almost certain to keep on falling. And the core PCE deflator, which is the Fed's main inflation benchmark, has also been ticking down, and wages have been pretty depressed. So it's kind of hard to see this Fed hawkish talk being followed up in the near term. Most people are thinking now June is unlikely, and people are pushing forward their forecast date for a hike from the Fed to the third quarter, some even the fourth quarter. I've even seen some only next year. So you take your pick, but it looks like June would be at the very earliest of most people's estimates right now.